Why doesn't gold climb when you expect it to? Well, it's a question that keeps coming up, especially lately. The world feels like it's teetering. There are wars, political chaos, economic uncertainty. So you'd think gold would be soaring. But look at the price chart and nothing. Maybe a flicker, a modest uptick, but nothing like the fireworks you'd expect. It's not just this week. Time and again, we see dramatic headlines, conflict in the Middle East, missiles flying, threats and counter-threats, and yet gold barely stirs. Why? Is gold broken, or is something else going on? Gold has always been a mirror held up to human institutions. When confidence in those institutions grows, gold slumbers. And when confidence fades, gold climbs. That ascent is never merely a story of profit. It's a siren warning that the structures we live under may be cracking. We live in a world built on layers of promises. Governments promise stability, central banks promise purchasing power, markets promise growth. And those promises rest on fiat currencies that can be created at will, on debt that never seems to shrink, and on the blind faith that tomorrow will look vaguely like today. As long as that faith holds, people keep working, investing, and consuming. The engine hums along. But gold doesn't believe in promises. It doesn't yield. It doesn't campaign for your trust. It doesn't promise you future earnings because it just simply exists. And its value emerges when people begin to question the architecture of belief around them. Gold's rise is the market's blunt verdict on overissuance of currency or the credit excess and on the monetary delusions of the age. Each uptick in the price whispers that the invisible hand is totaling up mistakes that were made long ago. But here's the twist: gold doesn't always react to the news cycle. In fact, you should not chase the headlines because sudden geopolitical events, whether it's wars, invasions, missile strikes, that rarely drives sustained gold rallies. Sure, you might see a quick spike as those emotional buyers rush in, but history shows us that those surges are often short lived. At the start of the Ukraine conflict in 2022, gold spiked, but then it dropped 20% over the next 7 months before the longer term uptrend quietly resumed. A climbing gold chart does not declare that the economy is on fire. It suggests that something else is. When gold rises, it tends to accompany 5 overlapping trends: eroding purchasing power, flight from productive capital, loss of confidence in policymakers, sovereign debt stress, and geopolitical anxiety. And now, a sixth factor is joining the party: institutional fragility in the West. For example, while central banks like the Fed may retain formal independence, the political environment that they operate in has shifted. Interest rate decisions are now shadowed by presidential pressure and fiscal binging that once would have been unthinkable. The consensus that once underpinned the macroeconomic stability is fracturing, and the kind of political volatility that used to define emerging markets is now showing up. Gold does not do euphemism. It doesn't care for the spin. It doesn't really care whether Powell thinks inflation is transitory or not. It's not there to respond to press releases. It just simply reflects what everybody else feels. And what it reflects increasingly is disorder. From Nixon's temporary suspension of gold convertibility in 1971 to Bernanke's emergency QE in 2008 to today's endless monetary interventions, the truth is plain. The system survives by breaking its own rules. Temporary becomes permanent. The caution becomes policy, and every promise floats on hope and dilution. Because when you look at the dollar against gold, it's hard to argue with gold's verdict. For years, the gold price has been suppressed, not through overt manipulation, but through paper abstraction. 100-to-1 leverage in futures, unallocated pools, synthetic exposure. But now the mood is shifting. The demand for physical gold is rising. Vaults in London and New York are being drained. This year alone, the headlines about London and New York and the amount of activity happening in those vaults. And even the ECB warned that the rising demand for physical gold could threaten financial stability. Why? Because the system promised too much paper gold to too many counterparties. And now the calls are coming due. And it's not just a market problem, that is a serious credibility crisis. So you've been told that gold is outdated, that it has no yield, belongs on the fringe. Yet central banks, those that are most plugged into the plumbing of the global finance system, they are buying gold at record levels. Gold has overtaken the euro as the second largest reserve asset held by central banks. They are not buying ETFs, they are buying the real thing. And now they're not just buying gold, but they're questioning the global monetary architecture. China's newly appointed central bank governor recently declared that we are heading towards a multipolar currency order, and that excessive reliance on the dollar is a strategic vulnerability. Beijing is investing in alternatives, renminbi settlements, and digital RMB infrastructure, and bilateral deals with partners outside the Western bloc. Even Christine Lagarde has admitted that the dominant role of the dollar is no longer certain. This is not theory. This is policy. And while policymakers warn you off gold, they're quietly hedging their own bets. So why isn't gold soaring right now? Well, with all this going on, because gold's real drivers are structural, not emotional, major gold bull trends are driven by deep, long-term fundamentals: monetary policy, inflation, currency debasement, and systemic risk. Panic buying on headlines distorts the market, invites short-term volatility that hurts speculators. The real story is always slower, it's quieter, and it's more fundamental. When gold rises, trust falls. That's the equation. And it's a deeply political one, because a rising gold price doesn't just reflect dissatisfaction with money, it reflects dissatisfaction with leadership, with the choices made, with the very premise of the post 1971 economic order. It shows that people are beginning to question the story. That's why gold doesn't appear in political addresses. That's why rising gold is barely mentioned in press briefings. Because it's not that gold is hard to explain, it's because it can't be controlled. A public that sees gold rising while their purchasing power erodes doesn't nod sagely and just adjust their portfolios. They get angry. They ask why their wages don't stretch. They suspect they're being lied to. And this is why a rising gold price is a political risk indicator, not just an economic one. It signals the fraying of the social contract. And when the electorate no longer believes the numbers, politics stops being about policy and becomes about blame. And that is a very dangerous place for democracies to be. If you consider the miner and the canary, a silent canary means the air is safe. A twitch, a flutter, a fall, while the miner doesn't celebrate, he exits. Gold is the market's canary. It rises not to declare triumph, but to flag concern. It warns, it signals, and it gives us time. If governments respond by reducing deficits, restoring transparency, allowing real capital formation, then gold will settle back. But not because it was tamed, but because the conditions that woke it were addressed. But if they do not, well, gold will keep rising, not as a badge of honor, but as a marker of decline. So next time you see the headlines and wonder why gold isn't soaring, remember gold's silence can be just as meaningful as its rise, because in the long term, gold does not climb because the world is working. It climbs because it isn't. So if you are starting to get worried and you're wondering how you can exit from the system, well, why don't you click on the link below and download the exit plan now?